And Friday, we ended the week with a bit of a bummer. MBS were down 11 basis points early. Bonds began the overnight session with minimal losses, but yields rose at a faster pace when European trading started. There was no big ticket events or headlines driving the weakness, but some comments suggest an improved COVID outlook in China and higher oil prices were adding to the pressure. Most signs are pointing towards quarter point hikes from the Fed here on out. The mixed signals complicate discussions over when to pause following an anticipated quarter point on February 1st. Also, many different opinions out there on when the first rate drop will be because of recession, when that will come. Investors and economists continue to doubt Fed forecasts that rates will rise above 5% from their current levels just below 4.5%. Again, most people are predicting that there will be a recession coming fast and they'll have to cut rates pretty much immediately after raising them. This should be fun. Existing home sales fell 1.5% month over month, 34% year over year on a seasonally adjusted rate. Oh man, that's a big number. The median existing home price rose 2.3% year over year to $366,900. That sounds to me like all of the activity is in the lower price points, which has been the case for a while. There just hasn't been enough of it. Total housing inventory is 970 units. Unsold inventory is a 2.9 month supply, though traditionally about 30% of that is actually under contract. All cash buyers are still holding around 28% of sales. First-time home buyers represented 31% of sales, which is up from 28%. Properties remain on the market for 28 days, which is pretty low. Fannie and Freddie also have updated their LLPA matrices, which is going into effect May 2023. Your investors will probably do it a lot sooner than that, but basically it's reducing the penalty for low credit and high LTV and increasing the hits for people that actually pay their bills on time. Bonds rallied to the best levels a month earlier this week, but have been retreating ever since. At first, the retreat was gradual. By Friday, it was much more pronounced, still lacking any compelling scapegoats. Earlier in the day, analysts put in China reopening, heavy selling in European banks spilled over, hawkish terms like we talked about. Traders also may simplify things, also squaring positions ahead of next week with no Fed speakers or anything like that. At the end of the week, on the day we're down 16 basis points to 101.34, which puts us in the lower half of that very narrow range. That flat red line is at 101.671. The career red line is the 25-day moving average at 101.79, which has been providing a pretty good little channel right there for a week, 10 days-ish. So we'll look at next week, and next week, not a ton of stuff going on. We have Wednesday, we get a couple of auctions. Thursday, as usual, we get jobless claims, but we also get GDP advance and a 7-year note auction. Those could move the market. And then we get the core PCE inflation on Friday, as well as inflation sentiment. So those should be things that people are really paying attention to right before coming up to the Fed. Over the weekend, check out some more common influences at WellThatMakesSense.com, as well as MBS Highway, MBS Live, RunPrism.com, and of course, our sponsor, WellThatMakesSense.com. Have a great weekend.